well, hang on. Stop moves up. So you're almost break even at this point. So you've made 19 pips on this side of things, almost breaking even on the 24 pips of the original. Let me actually, since we moved the stop up, of the 20 pips. So you're one pip away from break even. And hopefully you can see that what I did was move the stop up from here, or from here to here. So we shaved 4 pips off of the stop and also brought the entry 4 pips closer. Now you can see we're still well into what? The sweet spot. Okay, here's 9 o'clock a.m. So right into 9 o'clock, the market did make its move to the downside. And then we'll just kind of play this out. Now this is where things can get tricky. Let me go ahead and continue. Because you're on such a small time frame, using the red moving average for a stop can be dangerous, quite frankly, because the distance is so small. Okay, so you have to keep that in mind, that as you're using a trailing stop, when you're on a low time frame, especially a 5-minute, and this is why I'm saying, again, if you're doing something in the background, focus here. If you drifted off and you're looking at something else, focus with me here. This is the danger of the 5-minute time frame. You have the market moving back. This is a normal kind of retracement, and then continuing to move. So you get the market moving down, up, down, up, down. This is very, very common, and this is why using the moving average on the intraday, I think, is inadvisable. Because you can get the market moving back on a very shallow retracement, because you have to realize here the market's only moved back 27 pips. The stop would have to be a little bit, it would be only 16 pips. So you're not giving the market very much room to move. So you've got to consider that as well. And also know, there's no ideal here. Okay, please don't ask me what's the best trailing stop to use intraday, because it doesn't exist. There is no quote-unquote best. If you're going to trade intraday, then you better be monitoring the position. My suggestion would be, and the techniques that I use, is to simply look at volume and to look at price. So when I see the market expanding the range, as it did here, all the way through here, the range expands. I see volume moving back up, and then look at this. I see the market make one move down, volume immediately drops off, small range bar, same volume. This is indicating to me, watch out, potential reversal. So at that point I need to decide how much of my profit am I willing to give up, and how far do I think the market can go down. Now this is where you've got to start using your trading skills. Okay, you've got to know where the likely stopping point for the market is. So if we go up to the hourly bar, we've been focused in on this very small point right here. If you look at the hourly bar, you can see that support doesn't really come into play until the market gets down here into this level, which is about 335. So if you're trading the market short up here in the 400s and your target is down at 335, does it make sense to use a 27 pip stop? Well, only you can answer that. Remember, you've got to fit it into your money management style. You've got to make sure that the risk makes sense for you and what you have planned out. What's a good strategy to use, especially for a trend follower, would be to go all the way back up here, where you've got 20 some odd pips worth of profit, and you're willing to let that thing go all the way back up here. That would be giving the market the most room to move and still form a trend to the upside. Why? Because until the market breaks back over these highs,